We are coming from a period of very low growth. And of course, you would expect then the year after that to get you to some positive momentum. And will it sort of be a game changer for the overall outlook? There we are more doubtful. There are more risks to the downside than to the upside.
The European Central Bank has cut rates for the third time this year, down another quarter of a point. This comes as the European economy is stagnating, but inflation fears now seem tamed. To find out more about what this means for the broader economy, we're joined now by Morgan Stanley's chief Europe economist, Jens Eisenschmidt from Frankfurt. Jens was also an economist at the European Central Bank for 14 years. Now, Jens, a quarter of a point, fairly mild decrease, especially compared to the U.S. What do you make of this?
In very broad terms, a central bank that is returning its monetary policy stance, this is the technical explanation or the technical expression for how interest rates are relative to the level at which they would be neither making the economy grow faster nor slowing down the economy. A central bank that is adjusting its monetary policy stance from a level that is restrictive at its core, so basically it's slowing down the economy right now, to a level where it's slowing down the economy slightly less or even not at all. And, predicated or basically a condition, a precondition for doing so is that there is some confidence that the main target, the price stability target of the ECB is within sight. So the ECB has a target of returning inflation to 2%. That is a medium-term target, so it doesn't mean it has to be the inflation that we are observing right now. It has to be the inflation in expected terms at some point, I would say, between next year and maybe even the year after. And so I think there has been some more confidence as expressed by the president today in the press conference and also in the statement that we are on track in that process. And that's why they were able to remove the degree or to lower the degree of restrictiveness of their monetary policy.
A lot to dig into there. You spoke a minute ago about the inflation targets, which is 2%. The September reading below 2%. Is there a risk that it could fall too fast?
That's clearly always a risk. Monetary policy is decision-making under uncertainty. So basically, you don't know the future. You just have to live with the fact that you have to predict the future and then come up with a policy that best expresses or is the best reflection of all these uncertainties. And as the president was also making very clear in the press conference, there are risks to the downside. And that is always to be understood as a risk relative to what is your central scenario. There are risks to the downside to that central scenario. There are risks to the upside. She also ventured to say that probably there are more risks to the downside than to the upside. I think if you just take the central scenario, the last one that was published, that saw inflation returning back to target at the end of next year. So back they saw basically in a durable manner or sustainable manner, as they phrase it, inflation being back at 2% in the fourth quarter of next year in the last staff projections that they published in September. If you are really trying to make it very, very detailed and have a very nerdy, sorry, the word assessment of the statement, then you could find material here. The previous statement had said that basically they expect inflation to be back at target during the course of the second half of next year. And that was changed to an expression saying it's during the course of 2025. So if you want, that could be read as the central bank now expecting an even faster return to target, even though, again, it's open enough as a statement that you can also find yourself there if you think it's still going to converge only by the end of next year.
Let's switch from inflation to economic growth because Europe has lagged behind the U.S., for example. How much does that weigh on the minds of the ECB when making a decision like this?
So, the president was very clear here, saying that, of course, we are targeting inflation, but we take into account growth because it affects inflation. How does it work? Well, a very simple way of thinking about it is, for instance, if you have less growth, at some point you will have also less tight labor markets, so unemployment rates will go up. That will lower the bargaining power of those in employment. That will everything else equal, lower wages. Lower wages get you lower inflation. So that's an obvious channel. I mean, economists typically talk about many concepts. Typically, it's framed as the output gap, which again has something to do with how tight labor markets are, or more broadly, how close the economy is operating at full capacity. So lower growth means everything else equal. You're more likely to come out below full capacity, and that should be less inflationary. So that's broader as a statement because it's not only about labor markets, it's also about other markets, other product markets. But, you know, the direction of travel is the same. In general, we could say we economists think and have good reasons to think lower growth means lower inflation.
Now, ECB President Christine Lagarde said in her statements that inflation could tick up a bit before settling lower again. But let's listen to what else she had to say after the rate cut was announced.
We expect the economy to strengthen over time as rising real incomes allow households to consume more. The gradually fading effects of restrictive monetary policy should support consumption and investment. Exports should contribute to the recovery as global demand rises.
Now, Jens, take that up. Do you think the economy will strengthen over time?
Yes, that's also our baseline. And again, remember me saying that this is decision under uncertainty. And as much as the ECB has an uncertainty here at hand, we have the same. We also need to forecast for our projections what we think is likely to happen. The main argument typically being made for European growth to rebound is, oh, we are coming from a period of very low growth. So remember last year was essentially almost no growth in the euro area. We even had negative developments in some countries. And of course, you would expect then the year after that to get you to some positive momentum. And the positive momentum, of course, has to come from several sources or comes from several sources here. Typically, you would think inflation is falling, as we just have heard, while wages are still catching up with the inflation wave from the last 2 years. So basically, wages in expected terms and also in realized terms as we see it will be above inflation. And that means real wages are growing. That means consumption should be, everything else equal again, helped by that development. Now, the big debate is by how much. And the other big debate is if you have a big uncertainty ahead of you, which is right now, you could argue the discussion, for instance, here in Germany, what is the future? Am I going to have my job still tomorrow, given what we have heard out of big automotive companies, for instance, what we have heard out of companies that are export reliant? Then you may, even if you have more money available, you may decide to save it, which means then consumption is not helped by that development. And to some extent, this is, I mean, we are seeing some elements of that. So the growth rebound is weaker than expected. It's still a rebound because remember, we're coming from very low levels. But that's a case in point for the ECB. They have a relatively strong rebound in their forecast in September. They have repeatedly cited downside risks to that forecast. And very likely they will revise their growth outlook down for next year at the meeting in December. Now, what does that mean? Well, it means still we have a rebound. We have more growth to expect, but less of that. And that could well mean that you have also less inflation. It depends on where you think is potential growth. What's the capacity of the economy? And I think in that backdrop, the lower growth got the upper hand here in the arguments in the governing council. So basically, I think the main argument was also, as reflected in the statement, we have lower growth to expect. And that also means we can be more confident on inflation.
You know, we spoke earlier about the cut already done by the Federal Reserve this year, but where does this rate cut from the ECB leave the central bank and the Eurozone in relation to other economies?
So this is typically played through markets, interest rate markets. So that's also something that is sometimes hard to explain because in a way, there is a decision and everybody focuses on the decision. The decision today was to cut rates, but that was fully priced in by markets. So in a way, what is important is what is the delta relative to, so what is the change relative to what was priced in before. And relative to what was priced in before, if I just look into markets now, the ECB is actually priced to cut more than was expected before. And that is mainly because there was a characterization that I referred to earlier, that most of the risks, or that if on balance, the risks to inflation outlook are probably tilted to the downside. So in terms of numbers, it's not a full cut more, but it's almost a half cut, so 12 basis points more. Last time I looked at that measure, and that means, for instance, that the exchange rate has further softened. So the euro has depreciated relative to the US, and that's exactly to your question. So relative to the US, in perception of the markets, monetary policy got more or got less restrictive in expected terms going forward than, for instance, the Federal Reserve is currently priced.
The German economy is the only economy out of the world's top 5 economies to be projected to be in recession for this year, but also we saw a recession last year. Will these rate cuts be enough to get German companies investing again and lift the country into growth?
I think it will help. And it's also part of our growth outlook that essentially 2 channels are at work here. One channel is investment channel, and you can already see it in the housing market. We had essentially data out of Germany on mortgages that start to rise again. So it seems that the housing market is turning a corner, which will take some time before this takes effect. But I think that's intended. That's the intended consequence. The other thing is investments in machinery equipment. That's also typically followed by rate cuts and helped by that. So that's firmly part of our forecast, and I would assume of the ECB's too. The other part is that the savings rate actually right now is maybe also propped up, so it's higher because of interest rates. So it's just paying you more interest to keep your money in your bank account. Now, with interest rates going lower, again, an intended effect of that policy, it's less favorable to do so. And so what you basically are doing is you save less, and that helps the economy again. And so, yeah, on net, I think that will help. Will it prevent the needed adjustments, and will it sort of be a game changer for the overall outlook? There we are more doubtful, given that the headwinds on the German economy are significant at that point in time.
An old nickname for Germany was the sick man of Europe. Is it fair to blame the German economy right now for holding back the Eurozone, or is there more blame to go around here?
Well, I mean, in a statistical sense, it's clearly the underperformer. So if you basically think about the German growth coming in even negative, as, for instance, the German government right now predicts for this year, slightly more positive, but not an awful lot more. And think about the euro area economy being predicted at somewhere 0.7 this year, at least that's our forecast. And if you think that Germany is part of that average, so then it's clear that it's, in a statistical sense, dragging down everybody else. And I would also say, in a structural sense, that is true. I mean, it has always been the case that if Germany is not going well, at some point also Europe will have a problem. Now, there is a bit of a nuance to that argument here. I mean, right now what we are seeing is an atypical growth constellation with what is called the periphery, so countries in the south of Europe growing more strongly. Biggest exception probably is Spain. These are helped by tourism, are helped also in the case of Spain by strong migration flows, also helped by a general more positive consumption dynamics in that country. And in some sense, there is a bit more emphasis in these countries on the service sector. And maybe this is what Germany has ahead of itself, a pivot away from a very strong manufacturing base. So just as a sort of number here, Germany has one of the largest shares in the developed world in manufacturing. So production, really, industry in GDP is around 20%, a bit above even that number. And it's above everybody else in the euro area. The next closest country is Italy. And everybody else has a higher, by implication, share of services in the economy. And it's very well possible that we are just seeing the beginning of a needed structural change away from manufacturing towards a larger services share. And to that extent, if that's true, and if that's a good characterization of what's going on, then in a way, the growth model of other countries may be actually more suited for this new environment.
That's Morgan Stanley's chief economist for Europe, Jens Eisenschmidt, joining us from Frankfurt. Jens, thank you so much.